Welcome to the deep dive. Today we're jumping into the world of commodity trading.
Yeah, specifically looking through the lens of William Gallacher's book, Winner Take All.
Hey, think of this as, well, a shortcut. Trying to get the core ideas from a pretty complex area.
It definitely covers a lot. Gallacher goes into, trading strategies,
Mm.
both looking at charts and the bigger economic picture.
And brokers, right?
Yeah.
Money management, options, it's all in there.
Absolutely, the whole works.
So our goal here is really to pull out the key insights, the stuff that'll actually help you get informed without feeling totally overwhelmed.
Sounds good. Where should we start? The basics?
Yeah, let's do that. What was the original point of these commodity markets?
Well, originally, futures exchanges were really set up for hedging.
Hedging, you mean like for farmers and companies?
Exactly. Producers and consumers. They needed a way to lock in prices, protect themselves from future price swings, basically for stability.
Okay, that makes sense. Managing risk for the folks actually dealing with this stuff. But that's not quite how it looks now, is it?
Not entirely, no. Speculators have become, well, a huge part of these markets.
You're just betting on price movements, not actually using the commodities.
Pretty much. And that raises a big question one Gallacher tackles. Does all this speculation actually serve a useful purpose? Or is it just, gambling?
It's a fair question. Is it helping the market function or just adding noise? He mentions a quote, doesn't he? Something about the freedom to speculate.
Yeah, the Rosenthal report from back in '76, the idea was basically that this freedom is fundamental in a capitalist system.
So as long as the game is fair, it doesn't need some extra justification like helping businesses directly.
That was the argument presented, kind of a hands-off view.
Interesting. But it bums up against this other idea, the one Gallacher agrees with, that most commodity traders lose money.
Right. That's a widely held belief, and probably true for many. So the question becomes, is it an impossible game, or are there actual winners? Can you consistently beat the odds?
And that's what Gallacher is trying to figure out in the book.
Exactly. He wants to explore if sustainable success is even possible.
And he's pretty upfront about his own angle, which is good. Warns about books with hidden agendas.
Yeah, books that are really just trying to sell you some system or newsletter later on.
He explicitly says he's got nothing else to sell, just the book.
Which hopefully means we're getting a more unbiased perspective, a clearer view of the landscape.
Okay, so a market dominated by speculation, tough odds. How do traders actually try to win? This gets us to the two main camps, right? Technical versus fundamental.
That's it. The two main philosophies. Technical trading is all about the charts.
Looking at past prices, patterns, statistics.
Yeah.
Trying to predict the future from the past data.
Yeah, using mechanical rules. Gallacher finds those kinds of books pretty dry, as he puts it, all numbers and patterns.
Right. Not much thought given to the actual soybeans or oil, just the price action itself.
Whereas fundamental trading is the opposite. It's about forecasting based on economics, current events, supply and demand, the real world stuff.
So trying to figure out what a commodity should be worth based on what's happening.
Exactly. And Gallacher says this takes flexible and dynamic thinking because those factors are always changing.
But he notes a trend, doesn't he? Towards one side.
He does. He observes that technical trading seems to be getting more popular, even though he sounds a bit skeptical about it working on its own long term.
He uses that silver example, how you can misread charts.
Right, warning against just looking at charts in isolation. Market moves can be endogenous, driven from within, not by external news.
Like a self-fulfilling prophecy almost. A pattern appears, people trade it, it reinforces itself for a while.
Exactly. It might look clear, but maybe it's just temporary market dynamics. And he paints this picture of day traders glued to screens.
Who think fundamentals don't even matter.
Yeah, a surprising number apparently believe that. Just focused on those quick ticks up or down.
Wild. Okay, so whether you're technical, fundamental, or somewhere in between, you probably deal with brokers or advisors. What's Gallacher's take on them?
Brokers. This is important. He points out their main motivation often isn't your profit.
Is getting new clients.
Pretty much. Recruiting new players to replace the ones who lose and leave. It's a churn business model, in a way.
So their interests and yours might not perfectly align. Makes sense.
Right. He contrasts this with the warnings you get from people further away from the action who often just say, stay away, you'll lose your shirt.
So the advice from a broker, take it with a grain of salt.
Definitely. Healthy skepticism is advised. He suggests they don't always have deep market insights, and, well, the barrier to becoming a broker isn't that high.
Not like you need a PhD in successful trading to get the job.
Not necessarily. And while the firm might advertise expertise, individual brokers vary wildly.
And they move around a lot too, right?
Hmm.
Chasing better commissions.
Yeah, quite mobile. Doesn't always scream long-term strategic partner.
Okay, so rely on your own research, basically.
Got it. Now let's dig into some of those specific technical tools Gallacher mentions. He seems pretty critical of some, like Elliott Wave.
He does. Elliott Wave, Fibonacci sequences. He notes they appeal to a certain type of trader, maybe looking for like hidden order or complexity.
Elliott Wave. That's the idea that prices move in these set wave patterns, but he says it's not really predictive.
Well, he frames it more as an observation. Prices go up and down in phases, but it's so flexible.
You can kind of make it fit whatever you want to see.
Exactly. He jokes that bulls and bears can look at the same chart and both find ways confirming their view, not very useful for actual trading calls.
And Fibonacci, that sequence from nature, like rabbits breeding, how did that end up in trading?
Yeah, it pops up in nature. The idea in trading is that these mathematical ratios derived from the sequence might show support or resistance levels.
Feels like a stretch, maybe. Applying rabbit patterns to oil prices. You could certainly argue that. Then he gets into WD Gann. More complex theories there.
Gann, squaring of price and time. What does that even mean?
Gann believed price and time were sort of proportionally linked. So a certain price move might correspond to a specific time duration for the next move.
Okay, sounds a bit mystical.
It gets better. Gallacher uses this chart, Gann's paradox, figure 2.1. He shows how just changing the scale on the price axis completely messes up the interpretation.
You mean you can make the squaring work or not work just by stretching the chart?
Precisely, which kind of undermines the whole concept if it's that dependent on how you draw the picture. And apparently few analysts acknowledge this.
Wow. And didn't he have an anecdote about Gann himself?
Yes. He mentions Gann's son saying his father couldn't actually make a living from trading. He made money selling his courses.
Ouch. That's telling.
Very. His estate wasn't huge either, apparently. It casts doubt on the whole Gann mystique promoted by course sellers.
So beware of promoters promising insane returns, like 100% a year, based on these kinds of theories.
Absolutely. Gallacher makes the point later that those kinds of consistent returns are just not realistic in trading.
Seems like common sense, but people want to believe, I guess. Okay, so specific tools might be shaky. What about trading systems in general and the gurus selling them?
Yeah, he's cautious there too. Many promotions push a specific system, claiming it's based on, painstaking research.
But you should be skeptical. He mentions Wells Wilder and his distinctive ads.
Right, and Gallacher points out that even if someone did have a winning streak, was it skill or just luck? Did their system just happen to fit the market then?
Like the lottery winner analogy he uses. Win big once, suddenly you think you have a theory of winning.
Exactly that. And then these gurus emerge with followers who maybe don't question things enough even when the system stops working.
He tells that story about Larry Williams, the guy who won the trading championship.
Yeah, turned a small stake into a fortune. Huge publicity. But then...
Managing money for others didn't go so well.
Not at all. His funds apparently lost a lot of client money pretty quickly. There was even an NFA complaint about disclosure issues.
It really shows the difference between maybe a lucky streak or personal skill and managing money professionally and consistently.
Absolutely. And it brings up leverage, which is crucial in commodities.
Right. Small price moves, huge potential gains or losses because you only put down a small margin deposit. The cocoa example.
Yes, he lays out the math. A tiny shift in the price of cocoa can double your money or wipe you out entirely because of that leverage.
So trading with just the minimum margin required is incredibly risky.
Extremely dangerous, he emphasizes. Leaves you no room for error.
Okay, so strategies, tools, brokers, they all have pitfalls. What about the trader's own mind? The psychology of it?
Oh, this is huge. Gallacher stresses how vital it is to cope with the unexpected, making tough calls under pressure.
He contrasts it with, like, deciding whether to play golf in bad weather versus trading with real money on the line. Logic can just disappear.
It really can. He quotes Thoreau. Something about believing a pit is bottomless without checking.
Believing in the bottomlessness of a pit without ever taking the trouble to sound it.
Yeah, making assumptions, following the herd.
Exactly. And
Yeah.
he uses that hog chart example, how easy it is to get sucked in by a nice-looking pattern.
A perfect trend line looks foolproof.
Mm.
Then bam, market ignores it completely.
His point is blunt.
Yeah.
Chartists see what they want to see, not what is really there. confirmation bias.
Trying to find predictable patterns in things, like orange juice prices that depend on inherently unpredictable stuff, like the weather.
Right. Why expect perfect patterns? He also briefly touches on Richard Dennis and the turtles experiment.
Trying to train novices into traders with rules.
Yeah, highlighting the complexities even there. And notes Larry Williams popped up again later associated with turtle mania, despite his fund issues.
So our own biases, emotions, they can mess up any plan. Okay, what about indicators traders use to gauge sentiment, like volume and open interest? Do they work? Gallacher is pretty skeptical here too. He doubts they reliably predict prices.
Doesn't buy the idea that rising price plus rising volume always means bullish.
No. He gives a counterexample. One huge billionaire's trade could cause that exact signal, but it doesn't mean the whole market is bullish.
Just one big player skewing the picture. He uses that horse race analogy, right? Counting the crowd doesn't tell you who wins.
Exactly. It shows activity, sure, but not necessarily which way the market's really leaning. He also dismisses relying on what short sellers might be saying publicly.
Especially if they're losing money in a bull market, they might not be totally honest.
Precisely. And then there's the COT report commitments of traders. Lots of people watch that thinking it shows what the smart money is doing.
The commercials, the hedgers,
Yeah.
supposedly they know best.
Well, Gallacher questions if there is a consistently identifiable smart money group, and he says there's no strong statistical proof they always have an edge.
But some services track this, right? Like the Bullish Review, assuming commercials are usually right.
He acknowledges those exist and says, sure, you could test that hypothesis with historical data if you wanted.
But even if commercials did have an edge sometimes, in some markets, it might not be consistent enough to trade on reliably.
That seems to be his point. It's complex, and any edge might be fleeting or market-specific.
Okay, so even popular indicators aren't a magic bullet. What about just pure chance? How much is just luck?
A really key point. Gallacher starts by saying every trader is already behind because of commissions.
The house edge, basically.
Right. He brings in the random walk idea, market prices moving randomly, like spins on a roulette wheel where the zero is the commission cost.
So even random trading would likely lose money over time just from costs.
Exactly. And sure, there are big winners every year, but with so many people playing statistically, some will get lucky. Doesn't disprove the randomness for Gallacher.
He also talks about regression to the mean. How does that fit in?
That's the tendency for extreme results to move back towards the average. So a trader having an amazing year, maybe it was just statistical luck, not genius, and they'll likely regress back to average performance. Not understanding that can lead to bad decisions.
But he does say that the lists of winners and losers aren't totally random. Some people consistently win, some consistently lose.
Yes, that's the crucial distinction. While much daily action might seem random, trading performance isn't necessarily random. Habitual losers often use bad techniques, not just have bad luck, they repeat mistakes.
Which maybe explains the appeal of thinking someone has insider information. That must be the edge, right?
The insider myth. Gallacher pushes back on that too, at least for commodities.
He gives examples. Farmers, cattle ranchers,
Yeah.
people you'd think have an edge.
Right, or even foreign exchange traders close to the source. But he says they often do poorly trading the very things they supposedly know best.
Why would that be?
Maybe an insider's bravado, he suggests. Overconfidence. They get stubborn, refuse to admit they're wrong, hide losses because they know they should be right. Too close to it emotionally.
Interesting. Okay, so if inside info isn't the key, and many indicators are unreliable, what does correlate with success, according to him?
Trading with the trend seems to be one style he identifies as indicative of winners.
Following the market's main direction. But he says it's harder than it sounds, and less common.
Yeah, psychologically tough. Our instinct is often to buy low, sell high, fight the trend. Trend following means accepting lots of small losses, hoping for fewer, bigger wins.
And if you've just taken some hits, you're tempted to grab tiny profits too soon and miss the big move.
Exactly that temptation. Discipline is key.
Okay, so trend following might have something to it. Now, he actually tests a technical system himself, right? This plot ad thing. Why?
Well, even though he's skeptical of technical trading alone, he knows it's super popular. So he designs and tests plot adder as a sort of representative example.
To see what kind of results a purely mechanical trend following system might realistically produce. Not endorsing it, just studying it.
Precisely. And he sets criteria for a good system design. Clear direction, symmetrical rules for long short, universal, not tied to one data set, and always in the market, consistent.
And Plotters is based on 10-day highs and lows.
That's
Pretty
a
simple.
really simple reversal system, yeah. When he tested it on pork bellies for a couple of years, it actually made money overall.
Wow.
But the equity swings, the drawdowns, were enormous, huge volatility in the account value.
And when he tested it across 10 different commodities, the average returns looked amazing on paper, right? Percentage-wise.
Yes, but that's based on margin, not total capital. Makes the returns look deceptively high, a common trick in the industry. It doesn't reflect the real risk.
The really interesting part was comparing plotter to random trading, wasn't it?
Absolutely crucial. He ran simulations with random price data. Plotter got, say, 385% average annual return in the test. But 99% of the random simulations fell within a very similar range around zero, plus or minus 375%.
Meaning plotter's success could easily have just been luck within the bounds of random chance.
That's the strong implication, a very sobering finding for purely mechanical system fans.
And he also warns about system sellers cherry-picking start and end dates for their track records, right? Like starting right after a crash.
Definitely. You need to see the whole picture, warts and all, not just the convenient parts.
Okay, so even if a system looks good on paper, reality bites. What about execution costs?
Ah, yes. Hypothetical returns ignore the real world. Things like your stop-loss order not getting filled where you wanted.
Or the market gaps down limit and you can't get out. The system assumes you got out, maybe even went short, but you're stuck.
Exactly. Happens all the time. And then there's slippage.
The difference between your expected fill price and the actual fill price.
Right. And it happens when you buy and when you sell. Gallacher estimates, based on his experience, it could be quite a chunk per trade. Maybe a $160 round turn back then?
Add commissions on top of that. Say $75.
You're looking at over $200 in total costs per trade before you even start making profit. That eats into those theoretical system returns significantly.
He shows tables where these costs just decimate the nice-looking results.
They really do. And he also shows the drawdowns for Pleodorter across different markets. Even profitable markets had surprisingly deep losing streaks.
That pork belly example after the USDA report wiped out months of gains.
Yeah, shows how quickly trend-following systems can get hammered by sharp reversals.
Yeah.
Underscores the risk, even with a system.
But he does offer one way to mitigate some risk.
Diversification, trading multiple uncorrelated commodities.
Don't put all your eggs in the pork belly basket.
Basically, yeah. It can smooth out the ride, maybe lower overall margin needs.
Yeah.
His analogy is guys crossing a stream holding onto a log together.
Nice visual. Okay, so diversify.
Yeah.
But system trading still has traps, like optimization.
Huge trap. Vendors sell systems you can optimize tweak parameters until they perform perfectly on past data.
That's overfitting, right? Making it fit the past so well, it doesn't work in the future.
Exactly. High risk, it won't predict anything. And then there's just boredom.
Boredom for the system trader.
Yeah, it's mechanical, follow the rules. It can get monotonous. That leads to tinkering.
Impulsively changing things. Ignoring signals because you feel like it.
Right. Starting to override the system based on gut feelings or recent noise, that's often the beginning of the end for a systematic approach.
Plus pressure from clients if it's having a bad run. You got to change something.
Exactly. And deep down, Gallacher suggests the trader always doubts if the future will perfectly repeat the past the system relies on.
So big drawdowns lead to panic, changing rules on the fly, often making things worse.
It's a common pattern.
He's particularly sharp about systems claiming huge success, like that Bruce Babcock example.
Oh, yeah. Babcock had this system, supposedly amazing back-tested results, but
Gallacher says he only traded it on paper after the fact.
apparently so. And even Babcock admitted it might have lost money in the following year, including during the '87 crash, even though the system supposedly flashed a buy signal.
And the system was complex, traded very rarely.
Yes. Fewer trades, more complex rules. That increases the risk of curve fitting even more. Statistically less reliable.
Yet, Futures magazine ranked his systems highly later. Weird.
Shows how hard it is to really judge these things sometimes.
Okay, so individual systems are tricky. What about professionally managed commodity funds? Surely they do better.
You'd think so. But Gallacher observes that while funds have grown, their overall performance is often underwhelming. And most use technical trading.
So lots of funds chasing the same kinds of technical signals.
Seems that way. He argues that long-term, all this technical trading probably doesn't affect prices. Much fundamentals win out eventually, but short-term,
It might increase volatility and maybe even reduce the returns available to those technical traders.
that's his suggestion. More competition for the same signals might be eroding the edge. He also notes many funds from the early 80s disappeared or merged.
And performance year to year is really unpredictable. Hard to pick winners consistently.
Very regressive, he says. Hard to pick winners based on past performance. And he wonders why fund returns are often so much lower than theoretical systems like Pilo de are even after fees.
Suggests maybe managers aren't always sticking to their stated systems.
Raises the question, definitely. Contradictions between belief and action, perhaps.
Okay, funds aren't a guaranteed win either. What about the next big thing? Artificial intelligence. Can AI crack the code?
Gallacher was writing a while ago, but his skepticism still feels relevant. He doubted AI or neural networks could just unlock secrets from price history.
His question was, how would AI handle something totally unprecedented like the '87 crash? It wasn't in the training data.
Exactly. And he cited a study back then on IBM stock using neural nets, found no real predictable patterns after looking at tons of data.
So he predicted the AI hype in trading would fade as results disappointed.
Pretty much. He thought real AI breakthroughs would come from science, not finance trying to predict prices.
So no magic algorithm. Which brings us back full circle to fundamentals. What's the core idea there?
Fundamental traders are looking at the underlying value, taking positions when they think prices are genuinely too high or too low based on supply, demand, economics.
Voting for equilibrium, essentially. Unlike technical traders just chasing momentum.
That's a good way to put it. They might even exacerbate imbalances short term. To do fundamentals well, though, you need deep knowledge.
Right, he uses pork bellies as an example. Technical traders avoid it as too wild.
But he argues it's actually quite predictable if you understand the hog cycle, inventory reports, etc. Need to know the specifics of each commodity.
Soybeans, gold. Each has its own story. He stresses that liquid markets react fast to news.
Yeah, the current price usually reflects known info, so a forecast needs conviction, needs action, not just wishful thinking or politics.
Like his gold bug example. Always bullish, ignoring the bear market. Danger of fixed beliefs.
Definitely. And bullish or bearish often just describe the past, not predict the future. He uses soybean data supply, price, usage to show how history gives context. Is the current price out of line with historical norms given the supply situation?
Similar analysis for corn, wheat, cocoa, sugar, looking at the key drivers.
Exactly. For pork bellies, it's seasonality, slaughter weights, inventory, how the market reacts to surprises.
Gold's relationship with crises changing. Interest rates, stock indexes, lots of factors, but still hard to predict perfectly.
For sure. He notes the stock market's resilience after '87 was surprising to many.
So fundamental analysis is about deep dives into specific markets. But how do you trade based on that? It's not just having an opinion.
Crucially, Gallacher says even fundamental traders need clear exit strategies, often technical ones. Why?
Because fundamentals might lag. Price action can get disconnected, especially near tops or bottoms.
Exactly. Your fundamental view might still be right long term, but the market can overshoot wildly short term. You need rules to get out.
He tells that story about his friend George and the orange juice trade. Based on a weather report, but no plan.
Yeah, impulsive, ill-planned disaster highlights the need to avoid decisions made under stress.
So, have a plan before you trade. Objectives, risk tolerance, stop-loss levels, profit targets. Know what you'll do in advance.
Absolutely critical. He then uses the Japanese yen in the early 90s as a case study.
Showing how a fundamental view yen is overvalued and undervalued could be traded. Contrasting bulls and bears.
Right. He compares his technical plotter system on the yen to a hypothetical fundamental approach.
And introduces an override for the fundamental system to stop buying constantly in a bear market, even if fundamentals look cheap.
Yeah, a practical rule. Stops you fighting a strong trend indefinitely. Shows it wouldn't hurt much during the bull market either.
The main point being, judge the trade based on your initial fundamental judgment, was yen overvalued at 7,900, and your execution plan, not just where the price ended up later.
Precisely. It's about the process and the plan based on your analysis.
Okay, solid plan needed. Which leads directly to money management. Huge topic. What are his key principles?
Well, he tackles the famous 2% rule, don't risk more than 2% on one trade. He questions if it's really that simple or universally right.
Uses a coin toss analogy, arguing trades aren't totally independent when your capital is on the line.
Right. And he strongly advises treating trading capital as sacred. Invest it once, don't keep adding more if you lose.
That's quite strict. He also says tighter stops don't necessarily reduce your overall drawdown risk.
Yeah, his analogy is a road trip. Needs the same amount of gas whether you drive for 2 days or 10, Smaller losses more often can still add up to the same big drawdown over time.
He focuses on exposure, dollars of equity per open position. That's key.
Very key. And the paradox. Successful traders increase position size as equity grows, meaning maximum exposure right before a potential big drop. Ouch.
So you need to think about your largest expected equity drawdown, LEDD. How much capital do you really need?
Yes. He shows estimates based on daily ranges of commodities and again highlights diversification helps reduce that need.
Then he goes after optimal F, that formula for optimal bet size.
Calls it phony optimization. Why? Because it's extremely sensitive to the exact sequence and size of future wins and losses, which is unknowable. Small changes in assumptions lead to wildly different optimal fractions.
So no magic formula for position sizing either. Okay, last big topic, options. What are the basics he covers?
He explains calls, right to buy, and puts right to sell futures contracts at a set strike price by an expiry date. Buyers pay a premium, sellers, writers, collect it.
Buyers hope for a big move. Writers hope for stillness or small moves so the option expires worthless.
That's the basic opposition. He notes it's anonymous, positions can be closed early, fixed strikes, fixed expiries. Option price depends on strike versus futures price, volatility, time left.
And he explained how futures price moves affect call and put values, then introduces straddles.
Buying or writing both a call and a put. Same strike, same expiry. Betting on either a big move, long straddle, or little movement, short straddle.
He shows results for writing straddles on different commodities, wheat, silver, oil. Profitability varied a lot.
Yeah, not a guaranteed winner. Depended heavily on the market's volatility during the period. Swiss franc, too.
And he noted premiums were higher in silver and stock index options compared to currencies, maybe reflecting past blow-ups.
Possibly. Like the 87 crash making S&P put some more expensive long after. Market memory, perhaps.
Wow. Okay, that adds even more complexity. Well, this has been a really thorough look at Gallacher's winner-take-all. Quite a journey.
Definitely covered a lot of ground. Trading psychology, strategies, brokers, systems, money management, options. It's all interconnected.
Main message seems to be, well, be dynamic, be skeptical. No easy answers, no perfect systems.
I think so. No consistently working machines, no obviously right or wrong trades. Need an open mind, critical thinking. His goal was just an accurate description for novices and traders.
Right. A realistic picture. And for a final thought, he has that provocative idea about successful speculators.
Yeah, that maybe the ultimate success is walking away, or at least reducing your involvement to enjoy the winnings rather than getting hooked on the action itself.
Interesting. Maybe true success is breaking the addiction, something to chew on.
Definitely. We hope this deep dive helps everyone approach commodity trading with informed skepticism. Thanks for joining us.